Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented as always by Tusk Media. Real quick, give us a follow on Twitter at Tusk Media LLC, on Facebook.com/Tusk Media LLC. Also, we are on YouTube, YouTube.com/Tusk Media LLC. All our videos are there if you're watching this on Seeking Alpha. Thanks. Leave us a comment, leave feedback, all that good stuff. I'm Andrew Hall. Joining me today, Ben Nye. Ben, how are you?
I'm doing well, thank you.
Very good, very good. So we're going to jump right in. Today we were talking about Google. We've talked about this company a couple times. We've previewed earnings before. We've recapped earnings in previous quarters, and that's kind of what we're doing today, doing a little bit of a recap. Ben, quick, high-level analysis, what things really stood out, either good, bad, or otherwise?
Well, I mean, with Google, or Alphabet, I guess this is now known, you can't really make too much out of one quarter. And so last quarter they had a bad quarter. They missed on earnings, presumably because of the write-down to the fiber assets that they had. I think it's like $350 million write-down. This quarter they had a really nice beat, posted EPS of $7.73, estimate of $7.42. They now do not exclude stock-based compensation from their earnings, which is a positive move by CFO Ruth Porat. And revenue, ex-traffic acquisition costs, hit $20.12 billion, estimate was $19.76 billion, which is very strong growth, and worked out to 22.2% year-over-year growth. Interestingly, that was the second straight quarter they posted 22.2% revenue growth. So the headlines were good, and you saw the stock react positively to that.
So talking specifically kind of about that revenue growth, where it's coming from, all that, we've talked before about kind of the different levers that Google has to pull, things like that. Dating back really to probably the earliest days of this podcast, we've talked about those things. But we really look at kind of two metrics, the CPC, which is the cost per click, and the paid clicks. What did we see with those two points of analysis?
Well, in cost per click, it's just been a precipitous decline. So what you can do is you can go back over history, and the Google never actually gives you the actual cost per click, but they say how it trends on a year-over-year and quarter-over-quarter basis. So what you can do is go back and index them, which is what I did. And so if I indexed it to 100 back in 2008, I'm down all the way to 57 today.
So solid decline continuing.
Solid decline on cost per click. A lot of that is the transition to mobile, because on mobile devices, it's still a maturing platform. Paid clicks, though, continue to rise pretty dramatically, and that more than compensates for the decline in cost per click. So don't get too bent out of shape over the cost per click as long as paid clicks are rising, because that means that, in fact, I like paid clicks more because it demonstrates that Google is really driving traffic, and they're driving traffic to actually click on ads. So I view that as an endorsement of the Google platform, an endorsement of the strategy, and an endorsement that Google is becoming so entrenched in search and advertising. If you make a search, you go to Google. If you want to advertise online, you go to Google. And that's just, it's the place you go. And I think as long as that continues, Google has a lot of running room in front of it.
So you mentioned running room and growth. Another area where we saw a lot of strength was kind of an operating margin, which seems to lend itself, I would think, to the strength of those paid clicks. Because, again, if you are cornering a market and people are coming directly to you to kind of be their go-to partner, I guess in some regards maybe this lends itself to Google being an advertising company, or a lot of those tropes that people throw out there. But how are they gaining strength on operating margin? How are they improving there?
Well, what happens is, for Google, it's a very simple equation, because they have the luxury of dramatically growing revenue. So as long as they can grow expenses at a rate that is less than the rate that they're growing revenue, you're going to see that operating margin expand. And that's what happened. And you'll have periods. It's extremely lumpy for Google because they pay these big bonuses. They have these one-time items, like they have the fiber write-down. They're now including, which is very important, they're including stock-based compensation within those operating expenses, which means that the operating margins that are reported are probably going to be has some headwinds over the first 2 quarters of this year. Back half of the year, when stock-based compensation is going to be less, you should have even easier comps on the operating margin side. So I think there's a good pathway for margin expansion over the remainder of this year, and the revenue growth continues to portend pretty well for that as well. One caveat to revenue growth is that they do have some tougher comps and going into the back half of the year, but I think they're going to more than make up for that with improved operating margins, and I still think that revenue is going to grow in that 20% range. I'd be surprised if it wasn't around 20% for the full year.
From a transparency standpoint, it certainly seems, the way they've shifted to account for stock-based compensation is something of a mature move in some regards. It's one of the things that it's usually not too terribly hard to pull that out when you're looking at a company's financials and seeing what's actually happening. So usually that's something as an analyst you can kind of adapt for pretty easily. But it's nice to see that. It makes things a little bit easier, a little bit more transparent. I think again speaks kind of to the maturity of the company and its leadership. With that in mind, we're also kind of starting to see a little bit more about what's important to Alphabet in terms of what its total strategy is, where they're putting their emphasis, and what's that looking like over the next little while.
Yeah, I mean, they're really broadening their reach. They're doing some of the similar things to Amazon, except I think that their strategy is a little more defined, whereas Amazon's kind of going after everywhere. They have Chime, they have Echo, they have
all these things.
They have so many. They had, remember the Amazon Fire phone?
Yeah, forget about that.
And so they're doing a number of things. They got the spaceship or whatever they're doing with that.
Amazon's trying to be everything for everyone.
Yeah. In contrast, you have Alphabet, who is really focusing on 3 other bets, they call them. And they are cloud, hardware, which is their smart home and that stuff, and YouTube. 3 areas where you say, it's not extraordinarily speculative. Like, these are secular growth stories if Google can get it a good foothold. And I think they're doing that pretty well. Majority of growth CapEx is going to the cloud, which I think is actually a pretty good allocation of capital. They're continuing to really look to augment their G Suite, which is their portfolio of applications, and they're competing with some of their providers. Honestly, I looked at a report about Akamai, which is the kind of last mile CDN, content delivery network, and Google's getting in there. And so if you look at some of the markets that Google is targeting, these are clear, defined, high growth markets where the TAM, the total addressable market over the next 10 years, is set to expand dramatically to a level that's material enough to make a difference to Alphabet. I think you look at things like the Apple Watch, for instance, and it's like, is that total addressable market really going to make a difference to Apple, even if they got a huge portion of that market? And it's more difficult to make an argument for that versus Google getting into the cloud. So I think that Google has a lot of ways to win with this strategy and with the performance that they're able to put up with their legacy business and kind of reshuffling those dollars and making wise investments.
I think one of the areas that's most intriguing in terms of their general strategy is actually YouTube, platform we're really familiar with. We're probably on it right now. There's a great chance you're watching us on it right now. But what's interesting about YouTube is it's one of those things that is as common as it is in everyday vernacular for everyone across the country, probably in the world. It's insane that it's not a larger piece of the business, so to speak. Really kind of unreal. And you look at the premiums that are placed on things like Netflix and some of these video subscription services, things like that. It seems like that's a relatively untapped market from a revenue and profitability standpoint. Obviously, it's ingrained everywhere, but it seems like it's got such a large moat in terms of the cachet that goes with its name and the brand that goes with it. Something to kind of keep an eye on, I think, is just how they kind of continue to leverage that. YouTube Red, I guess, rolled out, about a year ago when they started doing that. I think that's something that, still has some legs. Be interesting to kind of see what develops there.
And YouTube TV, which they are in the process of rolling out.
Be huge.
I mean, that has, great potential. And especially if they can continue to refine their algorithms, both on the advertising side and on the user side. If you can go into YouTube and have essentially a curated list of 5 videos that you can watch, people will spend more and more and more time on that rather than going to Netflix and just looking for what to watch for half an hour.
And what gets really interesting there is just when you look at the CPM model in terms of what it costs to actually have 1,000 advertisements play on video platforms, especially mobile video platforms. They're pretty steep. And so what gets interesting there is you could really quickly, YouTube could make a play into original content, things like that, and offer it still as basically a free service. You're just going to have to watch 2 30-second commercials in the middle of it, the same you would with a free Hulu subscription or things like that. Seems like they could really make a play there. So definitely something to keep an eye on. Ben, any other thoughts on Alphabet and what Google's doing?
I'm pretty positive on it. As far as the FANG stocks, I have to say that this one is the most attractive to me because I think that, well, first of all, you have a much more reasonable valuation, right? These guys have $135 a share in net cash on their balance sheet, demonstrably strong free cash flow, about 23, 24, maybe 25 times earnings today. But you can actually wrap your mind around that when it's growing at 22% and having expanding margins. So it's one of the more attractive of those FANG stocks.
Yeah, it's definitely we can talk in circles about how to value Amazon, and the running joke is that I still like it in the low 400s. We can talk about that all day long and try to put numbers on it and try to figure it out, but it's so nebulous to really understand what they're really accomplishing. Not to say it's not a company worth investing in, but with Google, you're a little bit more grounded in reality, it seems like, but still kind of getting that upside that you're talking about with that growth. Thanks for being here. Leave us comments if you're on Seeking Alpha. Follow us on Twitter, Facebook, YouTube, all that good stuff. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.